Abhishek, to continue where Radhika left off, both as far as liquidity is concerned, as Ritu was pointing out, as well as on the rate cut cycle from here on, given also the fact that we are in a very, very uncertain global mix. I mean, we've seen what's happening as far as the US bond markets, for instance, is concerned. But, you know, back home, what do you expect, what do you anticipate on both liquidity as well as rate cuts?
In liquidity, near term, while technically the durable liquidity goes up, this liquidity will only impact the banking system when it is spent by the government. So the pace of spending matters here in terms of when this liquidity really starts bringing down the money market rates more. It is likely that government could make changes to its T-bill borrowing calendar, like has been their preference. In the past, they have preferred, in the recent past, they have preferred to use any fiscal largesse to cut short-term borrowings and to carry lesser cash rather than cut dated borrowing calendar. It is again likely that Q2 borrowing calendar will be adjusted, and that could help bring down government surplus a little more quickly than would have been the case otherwise. For monetary policy, we are thinking there is scope for 2 more rate cuts. For a terminal policy rate of 5.5%. Inflation this year is going to be very low, perhaps around 3.5% only. In that context, 5.5% may look high, but going down further would increase the risk that next year when food inflation picks up, RBI will need to change course and hike again at some point. It is best if growth concerns are manageable, which is the case if a forecast of 6.5% still holds true for RBI, and that is quite reasonable, even if we are slightly lower. A 5.5% terminal policy rate should be suitable, and next rate cut is likely in the upcoming meeting in August itself.
Mr. Madan, Sabnis, just to pick up from that, in terms of action in the next policy, if this pushes the short-term rates towards SDF 5.75%, and if there is some sort of effective easing, how do you expect that to impact RBI's decision? And also, this surplus, if you see it as a form of monetization of deficit, would it really move the needle on inflation, the 2.69 lakh crores?
This particular transfer of surplus from the RBI to the government, if we are assuming it's going to take care of all the contingencies which are there in the budget itself, to my mind, it's not going to have any impact on liquidity. It's only a case of saying that if this additional 60,000 crores is going to be spent and the budget size is going to increase by this amount, only then will the liquidity impact come in. Otherwise, it will be a status quo if we're going to assume that there's going to be a shortfall on account of customs, maybe on income tax because of slower nominal GDP growth rate. I don't think liquidity is going to get affected, which means that the RBI will have to continue to look at liquidity as a different instrument. You keep looking at OMOs and VRR based on the need base, which is what they have been doing since April and May. Now, in terms of policy, I think the RBI has a very strange situation. One thing is to say that inflation has come down. There is a market expectation that interest rates are going to be lowered. But we should keep in mind the fact that we normally see the vegetable prices going up in October, November. This is because of the changing climate pattern, where the crop tends to get affected and food inflation spikes. So we need to see how the monsoon progresses. We need to see pulses, oil seeds. I think these are the 2 pain points which are normally there. We need to see as to what happens on the tariff front. And more importantly, from a banking perspective, I think we've seen that we have already seen a 50 basis points cut in the repo rate, but the transmission to deposits has been slower because I think there's always this fear for banks that funds will move to the mutual funds. The capital market is still doing well. So the absorptive capacity of the bank is also what they have to keep in mind. So therefore, we feel that the rate cut, while definitely is on, and what Abhishek said, we also believe that 50 basis points cut during the course of the year. June could be a status quo. Observe what happens in June and July before you take a decision in August, and probably accelerate in case everything looks good in the subsequent months.
All right. Radhika, quickly, just to sort of also get back to the contingency buffer being raised all the way to 7.5%. Now, given the current macroeconomic conditions, the RBI, of course, said it was prudent to keep a larger buffer with itself. But would it be safe to say this size of a surplus will not become the new normal? The 2.1 trillion we saw last time and 2.6 trillion that we're seeing now. This is more of a one-off and not really going to be sustainable going ahead.
Yeah, certainly. I think, attention really comes back to the basic math in terms of where the income is getting generated from. I think between years, we will see that kind of, up and down, which is this time around, I think the biggest contributor would have been FX sales, foreign exchange sales, and the change or the different gap in, what the dollar was sold at and what the dollar was bought at. So that would have been, I think, when the breakdown comes and the balance sheet is released, annual report is released, we will see that. So I think that would have been the biggest contributor, apart from some of the other non-interest income headings as well. But yes, I don't think one should take this as a given. The year ahead, as we are seeing on a daily basis, is a very different place. The central banks, policy makers have had to be, I'm sure, keeping their eyes on the target. A lot of things have been changing. So I don't think the government in its own math or the central bank is going to consider this as a given. But that said, again, it's a wide range. It's 4.5 to 7.5. So, there could also be years when the risks kind of settle down, and then we have the contingency, the buffer, the ratio is at a 4.5%. So that could also be the case. So it just brings a whole set of possibilities. But I don't think in the math as well, end of the day, this is also kind of not, I would say, an organic revenue source, right? Revenue source, typically, we should go back to the direct, indirect taxes. That's where the tax buoyancy, that's where the growth matters to revenues. So I would think attention should really be on that. So this is, if anything, a supportive or another additional source of revenue. So I don't think complete dependency will be on this source all the while. So it's going to certainly fluctuate between years. Good years, the buffer could come down. Bad years, the buffer could go up, like we are in. I wouldn't say bad, but a rather challenging backdrop as we are in currently.
Well, it's been a significant buffer over the last few years, Radhika, and of course, it's not something that you can depend on, but it's certainly been a significant cushion that the government has enjoyed over the last few years, and it's only been going up significantly. But let me end by asking each one of you, and Abhishek, I'll start by asking you, since we are talking about risk assessment at this point in time, given both global factors as well as domestic risk factors, what are you going to be watching out for? What will be the triggers that are on your radar as possible risks that the RBI will need to factor in?
Shereen, RBI is in a reasonably good place from the perspective of managing the volatile external sector situation. Current account deficit was below 1% of GDP last fiscal. That is what we estimate, and is likely to remain so this year with commodity prices, including crude, having come down. Yes, capital flows is an issue. BOP was in deficit last year, but RBI has done reasonably well in managing the FX market, its FX market interventions. So RBI should be able to frame policy based on domestic growth and inflation considerations. And on that basis, the task is not really that tough right now. Of course, global conditions can worsen more and downside risk to growth could increase. We have to monitor that. But right now, RBI is in a reasonably good place to respond with a clear, stable policy from monetary policy perspective.
Madan?
So in fact, I think given the way in which there is this uncertainty, especially on the global front, I think the major concern for RBI is that if at all we're going to see growth slowing down in the economy, there's definitely going to be some kind of an impact which is going to happen on exports. Exports being largely in the SME sector, I think the possibility of stress building up in the loans given to this particular sector is something which they would be keen to monitor, because I think that seems to be the major risk for the banking system when it comes to this uncertainty which we're seeing across the world.
Radhika?
I think for the central bank, I think in addition to what the other panelists mentioned as well, I would say the currency has become a lot more, it's allowed to take in the kind of cushion, pressure. So if the dollar, for example, weakens, the rupee strengthens, and which was very different from the past 5-6 years when the currency was kind of moving in the same direction or volatility was very low. So that kind of allows the currency to take in some amount of pressure and adjust. So I think that is something that the central bank would keep a very close eye on. And the other one is certainly the growth impulse. I think there has been a large realignment with what the street expected in terms of growth. I think the central bank has also come closer to that. Official forecasts have come closer to that. I think they would watch that very closely because end of the day, not only the external sector, which is trade, but also private sector capex cycles do draw attention from what local demand is doing and what global demand is doing. So there is a fair amount of linkage with how the external environment is. So I think this is where the central bank's attention would be. And having a low inflationary backdrop is certainly a big plus at this point because it gives them a lot more flexibility in terms of what they want to do to support growth.
Oh, that it certainly does. And we have seen that inflation print providing comfort to both the Reserve Bank as well as the government. Madhavi, I'll give you the last word on this.
While I think for me, as of now, the only risk RBI is sort of watching is the fluidity of the global markets, because the way global markets have sort of been very patchy over the past 1.5-2 years. I think wherever we've seen RBI really tilting its monetary reaction function has only been because of the global dynamics and less because of the domestic dynamics. So my sense is that currently we are very comfortable in the global dynamics, domestic dynamics. We are seeing pretty comfortable inflation scenario. We are comfortable with regard to current account deficits and the fiscal deficit as well. The only risk as of now is that of growth, for which RBI has already is in an easing mode. Plus, they are also ensuring that liquidity is adequate. So I think to that extent, they're pretty sorted as far as domestic dynamics are concerned. It's the global bit which is going to worry them. And I think they'll be very, very watchful of that, because global dynamics can get really nasty if uncertainty really drags.
Radhika, Madhavi, Arora, Madan, Sabnis, and Abhishek Upadhyay. Always a pleasure. Appreciate you joining us on CNBC-TV18 to decode the RBI's math as well as the implications of the enhancement of risk buffers. We will take a break here, but there's a lot more coming up. Don't go anywhere. We're back in a moment with more.